Hello friends, welcome back. We were discussing the FRM Part 1 Foundation of Risk Management, and we already discussed a few topics of the building block of risk management, how the risk management process is being developed at the organization level, what are the processes. We already discussed the 6 main building block of risk management process, such as identification of risk. Then once identification is being done, then measuring and managing the risk, then differentiating between the expected and the unexpected loss, then addressing the relationship between the various risk categories, then developing a risk mitigation strategy, and the last one, to monitor the whatever the strategy or whatever the framework we have made for the risk management, how it is working, or it is working with, as per the expectation of the management. And in the measuring and managing the risk, we discussed the quantitative approaches like value at risk or expected loss or economic capital. And in the qualitative analysis, we did discussed about the sensitivity analysis, scenario analysis, stress tests, and then we discussed about the expected and unexpected loss and how those being calculated and how those being measured and managed. And then we discussed about the enterprise risk management, how that function work in an organizations. Today I am going to discuss a very important topic, that is risk and reward, because risk management function is not limited to the managing the risk, but how whatever the risk organization is taking, how those risk taking activity will ultimately lead to the reward, because every financial entity is working towards profit maximizations or generating some revenue from their risk taking activities. So therefore this study is very important, how the risk and reward function in a financial institutions. As you are aware that the whatever the amount of risk we take the risk, it will directly lead to the rewards. And suppose we take high risk, then the possibility of the high reward. If we take lesser risk, the possibility of reward is also low. And this reward is having some variable component. This reward is not fixed, and this variable portion of this reward can be subdivided into 2 categories. The this variability which can be calculated, or which can be estimated at the start of the risk taking activity or event, is called expected loss. So this kind of a downside we can very well calculate and arrive, like what is the probability of default or particular counterpart, and what will be the exposure when the default happen, and what is the recovery rates. So all these 3 variables, with help of these 3 variables, we can arrive the expected loss calculations. Now the another thing of the downside, that is unexpected loss, which is very difficult to calculate or make an assumption how much this can be. Like we can say the COVID-19 situation which came in recently into the global financial market, but that activity was not predicted prior to 2019. So there was no such expectation, so there was no such probability of this kind of events, but this event has make a havoc in the financial market and the loss and lead to a various kind of losses to the various companies and various organizations. So therefore such kind of the loss is not nobody able to predict and nobody able to quantify. Now let me give some example how this 2 risk and reward function works when we take some kind of a transaction on board. Let's assume that one organization is looking to make some investment in fixed income securities. So the activity is to investment in fixed income securities. As you aware that broadly fixed income securities, we can have two options. One is the government securities. We also called it sovereign securities. On another one is corporate bond. As you know that the possibility of default in the government securities is very minimum, because they are if we say the historical data, except few 1, 2 and 2 countries, there was no default happen as far as the government securities obligations are concerned. And in comparison to the government securities, if everything is same, the chances of the corporate bond default is higher. It again depend on the corporate size, their ratings, their structures, their financial strength. But all the if everything is same, the possibility of default in the corporate bond is much higher than the government securities. So if the credit is the function which decide the risk and reward equation, so what we can arrive, the price of the government securities will be much higher. The government will demand much higher from the investors, and yield will be low. Let's say the price is P1 and the yield is Y1 for the government securities for a particular tenor. Let's say tenor is T1. This is a tenor T. Vis-a-vis, if we compare this, if we have to invest in the corporate bond for the same tenor T1, the price will be lower, because corporate cannot demand the same kind of the price which the government securities will demand, and therefore the price of this bond will be lower than the P1, and because price is lower than because price and the yield have the inverse relationship, the yield will be high, so therefore it will be higher than the Y1. So in the normal market conditions, if the credit function decide the risk and reward, so this is the equation. But in normal market condition, this is not the only function which drive the risk and reward. There are other factors also which have a major role when we talk about the price and the yields. The important factor that also we will consider is liquidity. The liquidity of the particular asset class where we are making an investment. If the liquidity is very deep, the market available for that security is very deep, when you can sell the securities without much price movement and without a time delay. So people will prefer to make an investment in such kind of the asset class where the liquidity is very high, the market of that particular asset class is very liquid. So that this also play a major role to arrive the pricing of that particular asset class. Then comes maybe another factor, that is taxability. If that particular asset class is giving some kind of a tax advantage, like whatever the income or profit you are generating from that particular asset class is exempted from tax, so then people prefer to invest on those asset class also. So therefore risk and reward is nothing but the price function of between the credit, liquidity and taxability. And what is the correlation between all these three? Like in normal, when there is a lot of demand for the various asset class and market is very liquid, there is a lot of liquidity available, the people are very bullish, the spread between the corporate bond and government securities is skewed to very narrow range, and therefore which is not the correct credit function, because the The price of the government securities should have more value than the corporate bond. But when everybody is bullish, everything is being sold at very easily. People forget the credit functions. They focus on the other factors like liquidity, taxabilities, and there are other factors which also drive the price function. So therefore, risk and reward will not follow the credit function of the theoretical credit function of the market. But in the case of the stress scenario, when the liquidity is not there in the system, there is like what happened in 2008 when US was downgraded because of the subprime crisis, and which led to the financial crisis. The liquidity was not there in the system. Nobody was looking to buy the corporate bond, and everybody was looking to invest in the safer asset class like government securities, and the yield of the various government securities which were having a very high rating at that point of time was negative. So therefore the spread was not justifying the credit function only. It was the other factors which were driving the pricing of that particular asset class. Everybody was looking to invest only in the safer kind of a asset class. So therefore at that point of time, all the credit functions was not working very properly, which the normal market conditions generally works. So therefore risk and reward is nothing but the function between the various factors which affect the pricing of the particular asset class, like liquidity, taxability, their quality of the credit. So all these are the few factors which affect the risk and reward. Now let me talk about the conflict of interest, how the conflict of interest can affect the risk and reward within organizations. This study where one trader whose compensation was directly linked to the profit he is generating from his trading position. Therefore, to get more compensation or get rewarded, he was taking some kind of positions which is not as per the organization's we can say risk framework. He was selling a forward currency. He was selling a forward currency. He was selling a forward which is having some kind of a premium. Like let's say in case of USD INR, let's say 1 year forward, it might be somewhere around 80 rupees per USD. He was selling this forward and covering in the spot. Let's say the rate is 77.50, and he is saying he is generating a profit of 250 rupees per USD. But he did not take into consideration the funding cost. He is not taking into consideration the funding cost which is required for selling a 1 year forward, because ultimately whenever he is selling the currency in forward, he has to fund the currency from the INR, which is having some cost involved. So such kind of the event might happen when the risk reward is made such a way that he taking unnecessary risk lead to some kind of a higher compensation. So just to avoid such situations or such kind of the event, there should be some kind of a risk management framework which can reduce this conflict of interest kind of a event within organizations. So there are three basic we can say functions, or three basic steps each organization has to adopt to reduce the conflict of interest, to give unfavorable reward comparing to the risk he has taken. So the risk recognition. And there should be a robust systems, and that should be daily monitoring. So these, if the best way to combat the conflict of interest to for the risk recognition and the risk and reward kind of a anomaly, we should have some kind of a risk recognition system which can recognize the risk at the department level, at the level of the when the risk is been emanating, from which department risk has been emanating. Second, we should have a robust management system. If that particular event where the one trader was selling a forward and covering it with the spot positions and generating a profit, if we have robust system which can throw up some kind of a alarm, this kind of a positions is not actual profit is not there, it is only a dummy profit or profit which is not actual profit because there is a funding cost involved. If you have robust system, so such kind of the event can be avoided. And third is the daily monitoring. There should be a monitoring system which, if there is a abnormal profit generating by one trader or some abnormal profit is generating by one unit, that profit should be reviewed on very periodical basis. Is there is some kind of a what we can say, some kind of activity which is not actually generating profit, but this kind of a profit is only dummy profit or profit which can have lead to losses when the transaction is going to mature in the futures. Maybe the short term there can be some profit being generated, but ultimately when the transaction will mature, there can be a loss event. Like suppose you are sanctioning a loan, subprime loan, or the customer whose rating is very low, and you are giving a very high interest rates. So initially there will be some kind of a big interest inflow from the customer, but ultimately when that loan is going to be repaid, when the principal amount will be due, and there is a possibility that particular borrower may default or may not able to pay back you the principal amount, then it can lead to a larger losses. So just to avoid those kind of the event, there should be a proper monitoring, robust system and risk recognition. So friends, let me allow to close this discussion, and then in the next discussion I will be discussing about the various types of risk and their categories, and which events falls in the particular risk category, how the risk can be categorized, and what are the basic factors to categorize which kind of risk fall in the which kind of the category. Thanks for watching. If you have liked this discussion, please share it with all the FRM participant, and they can be benefited by this video. Thanks and bye bye.